Stocks on Wall Street staging a modest rally Thursday, the S&P 500 rising 1% as we see this massive rise in oil prices lifting energy stocks. Well, let's get a better read of today's market. We're joined by Kevin Caron. He is a senior portfolio manager at Washington Crossing Advisors. Welcome, Kevin. So, Kevin, we got those staggering jobless claims numbers in the morning, 6.6 million last week, double that of the previous week, and nearly double what economists had been expecting. So, why didn't the markets fall on this stat?
Well, if you look at where the markets are, they've already taken a lot out in terms of market capitalization here in the United States and around the world to account for what is a truly unprecedented global event. It began as a health event, and now it's expanding into the rest of the economy. And the things that we're seeing in terms of unemployment in the claims figures relates to the most sudden and sharp shutdown of the U.S. economy we've seen maybe ever. So consequently, all of the estimates are going to be wide from the mark. All we can say at this point is that the economy is in for a very sharp downturn in the near term, but a lot of that is already priced into markets. The question is going to be whether we bounce out into a V-shaped recovery like some are talking about, or whether it's a slower crawl out. And this is something that the trends will be telling us in the weeks to come.
And Kevin will get, I guess, a jobs number on on Friday. But economists now believe that the U.S. economy is already in a recession. So, as you see it, will this recession be a short one or will it be a prolonged one?
We don't know, and there really is no way to know. It's contingent really upon the course of the virus and the extent to which society at large can come back to some kind of normal functioning. There's no precedent for this really, so it's very hard to draw comparisons with past cycles. But what we do have are some different scenarios that have been laid out there. So, for example, if you look at some prognosticators, they're looking for a sharp, what they call V-shaped bounce back, which still includes a recession, but then a quick recovery. There are others that are looking for something longer, and that could be something more troubling because not only is there the economy to think about, but there are a chain of obligations that are owed one to another, and that could lead to defaults and a more protracted thing. We just don't know at this point, and we need to plot very carefully over the next few weeks to see which path we're on.
And Kevin, at Washington Crossing Advisors, what changes have you made to your asset allocation in light of the stock plunge?
Well, the last thing that we did was we cut the equity allocation in early March. There were some signs that things were beginning to slow down before things became very unruly throughout the rest of the month. As we go forward from here, we have equity portfolios that we invest with more of an intermediate to longer term type point of view. And if that is your point of view, which is ours in those portfolios, we have added some equity exposure there. And more than the asset allocation mix overall, what's even more important is to understand that survivability here is key. So you want to own companies with low debt, very consistent profitability, and businesses that are dependable in the sense that they could hold their head underwater longer than other companies so that they can get through what might be a longer process here. So we hope for the best, but prepare for the worst.
All right. And as for your equity allocation, how did you raise the equity from what percent to what percent versus fixed income?
Sure. So we lowered the equity exposure coming into March by about 10%. And this is following our WCA fundamental conditions barometer. And all that barometer does is it looks at a host of indicators, and when it sees weakness, it guides us to less equities for a short-term 3 to 6 month kind of time frame. So that's something that is obviously going to weaken as we update it in the next month. And really, it's pretty well understood, though, that we're in some kind of very sharp recession. It's not how we got here in the last month that is as important. What's more important from here is to look at how the data and the trends evolve over the next 2 to 3 to 4 weeks. So we're going to be laying out a series of pieces on our website at WashingtonCrossingAdvisors.com that begin to chronicle whether we're on a V-shaped path to recovery or something that's going to be more gradual.
Okay, I'll keep an eye on that blog of yours. Thanks a lot, Kevin. Our thanks to Kevin Coran of Washington Crossing Advisors. I'm Fred Katayama, and this is Reuters.